So far we have looked at several things. However, the main idea here is for us to look at how the businesses are taxed. Usually the two businesses under this level, which is the partnership and the limited company. Under the partnership, we said that there are two areas that we need to look at. One is the admission and retirement of a partner during the year, which we have already covered, looked at the question, and that is settled now. We move on to the next one, still under the taxation of the partnership, which is now the conversion of a partnership business into a limited company during the year. So here we are. So as you can see, the main topic is about the taxation of the partnership. And the second now, after the admission and retirement, conversion of a partnership into a limited company during the year. You might have a business whose accounting year started running on 1st of January 2021, and that means that the accounting year will end on that 1st of December 2021. So you may find that when you are starting the business, you started as a partnership business. Partnership. And then the partnership operated for a period of 9 months. And then the last 3 months, come for example 1st of October 2021, you decided to go to the registrar of the company and register that partnership as a limited company. So that means that the last 3 months, this business is operated as a limited company. Now, the way we tax the partnership business is very different from the way we tax the limited company. So we want to see, in case you have such a situation, what do you normally do? So here we are, how we do it. Now, the following points are considered in case of conversion. So points considered. Point number 1 is that the taxable income of the partnership is determined separately from the limited company. Now you need to know, using the gross profit method. Only even if accounting profit is provided. Unless stated otherwise. So the key point here to note is this, that the taxable income of the partnership is determined separately from the limited company. So that means that when you're getting the taxable income, you determine the taxable income of the partnership as a separate item from that of the limited company. Like what I had illustrated here, for the first 9 months, you determine the taxable income of that partnership. Then the last 3 months, you determine the taxable income of the limited company. Now we are saying using the gross profit method only. So even if you are given net accounting profit, don't use, and this is the only time that we don't follow the rules that we said, that if you are given the net accounting profit, you have to use the net profit method. If not, then use the gross profit method. Like in this conversion, we don't usually do that. We always use the gross profit method only. Unless we are saying, even if the accounting profit is profit, unless stated otherwise. So we are going to see that there's some situation whereby the examiner, and it's usually for the exam purpose, you'll be told, start with the net accounting profit. If you're told to start with the net accounting profit, then you don't have otherwise. Then you have to use the net profit method. That is point number 1. Point number 2, you need to take note of, is that in partnership, amount paid to the partners i.e. partner salaries, commission, interest on capital, etc. are not allowable expenses. They are non-allowable, what we call non-allowable. However, upon conversion, the partners are considered the directors of the company. Amount paid to them becomes allowable expense. i.e., director's fee, remuneration, director salary, let me continue, salary, all these are relating to the director, commissions, etc. Very important that when you're operating a partnership business, if the partners work in the partnership business, you may end up paying them salary, commission, interest on capital, such. These we said in partnership are usually not allowable. You cannot deduct them against the taxable income. However, upon the conversion, when the partnership is converted into a limited company, we don't have the partners. Those partners are now considered to be the directors of the company. And if you pay them for service rendered, take note of that, for service rendered to the company, as the directors, those amounts now become allowable expense. Now, they are usually called director's fee, director's remuneration, director salary, director commission, but they are all allowable expense. Another item that is supposed to be point number 3, that upon the conversion, the company may issue shares and debentures as sources of additional capital. Now, take note of this. Cost of issuing shares, stroke flotation costs of shares, stroke cost of listing at stock exchange market, is usually allowable expense. And then debenture interest on the same point, that the debenture interest is usually allowable expense. In the company. So what we are saying is this, that once the company is formed, the company might not have enough money to do the activities. So they may decide to raise enough extra capital, and this is usually done through issuing shares as well as debentures. Now, we are saying at the point of issuing shares, the cost of issuing shares, which is also called flotation cost, or the cost of listing at stock exchange market, it is usually allowable expense. We allow them in the limited company. And it can only happen in the limited company because only a company can issue shares. Same case, if the company issue debentures, debentures are forms of loans. So the interest on the debenture is also supposed to be an allowable expense. That is supposed to be point number 3. Then we have the point number 4 to note about the conversion. That in partnership, taxable income is charged tax. Is charged tax on partners after distribution which is done using the income distribution schedule. The income is taxed on the partners at graduated scale rates. At graduated scale rates. This means, in bracket, same way as employment income. Upon the conversion, the limited company is taxed on its own income at corporate tax rate of 30%. That is what we are saying about this point, that in partnership, as we had seen or we had said, once the taxable income is determined, it is charged tax on the partners. We tax the partners themselves. And this we do once you make the distribution using the income distribution schedule. This we saw when we were looking at the taxation of the partnership, admission and retirement. Now, once you distribute, you should tax the partners at graduated scale rates, which is the same as the employment income. So you find that, like for the year 2022, the graduated scale rates for the employment income start from the rate of 10%, it go to the rate of 25%, and it is stop at the rate of 30%. So once you distribute the income to the partner, you tax them at that rate or at those rates, depending on the income they have. This we are going to see at a later topic. However, when it comes to the limited company, because the company is a separate legal entity from the partners or from the owners, we normally tax the taxable income on the company itself at the rate of fixed, which is 30%. So you determine the taxable income of the company, then tax it at the rate of 30% to get the tax payable by that company.